Hello good people, it's me Kumaitila Kositile, your money manager. As an investor, there are key investment words that you have to know. These words should be at the top of your mind, at the tip of your tongue. Every time you make an investment decision, these are the words and the numbers that are going to guide you to make sure that you are making an informed financial and investment decision. In today's video, I want us to look at this one key investment word, and that word is return on your investment. Return your investment. I'm sure as investors you've all heard of this word, return on investment. What exactly is return on investment? Return on investment simply is the measure of your profitability. It is answering the question, how profitable is my investment? As you take your money and put it into an asset, I am sure you are looking to make a certain return, and this is the return on investment that we are talking about. Nobody is taking money, putting it into an asset just deliberately to make a loss. You invest because you want to create value. You invest because you are looking for income. How do you then measure to ensure that this investment that you put your money in is giving you a good return? You do that by calculating or working out your return on investment. How do we then work it out? What is the formula for calculating our return on investment? It is very simple. What you need to do is you need to look at your earnings and you deduct the cost of keeping that investment. You then divide that we call it net earnings or net profit. You are going to divide that by the total cost that you have put into the investment. That is going to give you your return on investment. So let me take you through the 3 steps that you need to take to ensure that you are accurately measuring your return on investment. The first thing that you need to know is you need to know the capital that you have put in. I'm always surprised when talking to people and I'm asking them, how much have you put into this investment? And the answer that I get is, I don't know. Then I'm saying, then you are not an investor, because how then are you going to measure your returns if you don't know how much you have put into your investment? This is why personally, as a property investor and as someone who is not investing a consistent or a fixed amount of money, I invest as and when I have money, and normally my investments are very irregular. So I have made it a habit that every time I put money into an investment, I track it. I track it because at the end of the period, I want to be able to know in total how much I have put into that particular investment. I track my investment capital using my money manager's diary. Let me just show you here how I do it. You see here in the month of August, there were some investment activities that I was doing. This is a project, a renovations project that I'm currently busy with. Therefore, I did certain things and I tracked everything that I was doing. You can see here, I was recording every day. I'll have a recording. I'll describe exactly where the money went. I'll write the amount and I'll keep on tracking because I want to be able to know at the end of the month, how much have I put into this project, because once the project is done, I have to be able to sit down and measure my return on investment accurately. So for me, I use this tracker. This tracker is in the Money Manager's Diary, and you can simply get this diary for only 300 Pula 50. You can have it. It can be delivered at your doorsteps. That's the first step, tracking your investment capital. Let's move to the second step of accurately measuring your return on investment. Once you know your invested capital, you have to know your earnings. What type of earnings? What type of earnings are you getting from your investment? Different investment asset classes are going to give you different types of earnings. You invest in property, you are going to get rental income. You invest in stocks, you are going to get dividends. You invest in bonds, you are going to get interest. You invest in a money market fund, maybe in a bank account, you are going to get interest. You must know the returns that you are getting. Once you know the returns that you are getting, you should be able to know how much the earnings are on an annual basis. You have to know that. Once you know the returns, we move to the third step, which is knowing the cost of keeping that investment running. This is the cost associated with your investment. Different investments will attract different costs. If you are going to go and invest maybe in stocks, listed stocks, you know that you are going to incur brokerage fees, you are going to incur tax, withholding tax at 10%. You invest in property, you are going to incur your operating cost, which will vary, utilities, garbage collection, whatever, insurance, everything that you'll be paying towards keeping this property running. And then if you invest in, let's say, in a fund with a unit trust, you are going to incur management fees. So you need to know the cost associated with your investment. Once you have taken these 3 steps, now you are ready to accurately measure the return on your investment. Let me just take you through very, very simple examples. We always want to work out the numbers, something that can guide you to do your own numbers. Let's work out maybe property numbers. Let's assume that I have a plot that was freely allocated to me by my government. I'm going to do a block of 3 units, 1 rooms. The total that I'm going to put in is 75,000. I've worked out my numbers and 75,000 is a realistic number. So I put in this 75,000. That is the capital that I am putting in. Then once I have done, I've built the block, I have the tenants moving in, I start receiving my earnings in the form of rental. And let's assume I am getting 1,800 rental, monthly rental. What I'm going to do is I'm going to take that 1,800, multiply it by 12 to get my annual rental. And my annual rental is going to be 21,600. This is my earnings. Once I know my earnings, 21,000, I need to now work out the costs. How much is it costing me to keep this property investment? And let's assume that I've worked out the numbers and it's costing me 465 pula monthly to keep this property investment. We are going to multiply this 465 pula by 12 to get the annual cost. And the annual cost is going to be 5,580. Now I know my earnings, I know my costs, I have to work out my net earnings or my net profit. My net profit is going to be 21,600 minus 5,580. I am going to get 16,020 pula. That's my net earnings. How do I then arrive at my return on investment? It is going to be the net earnings. Remember, my net earnings is 16,020. I am going to divide this by the total capital that I had put in, which is 75,000. I am going to get a return on investment of 21.36%. 21.36%, that's my return on investment. Whether it's a good return or it's a bad return is another thing altogether. Because for you to measure if it's truly a good return, you have to compare it against something. You cannot look at it in isolation and come to a decision that it is a good return. However, what you can do also as an investor is you can have your own investment criteria or investment benchmark. Personally, I do have my own investment benchmark when I look at my property investment. I am always looking for 1 double-digit returns, and I've set myself a 15% return. So when I do my workings, I am looking at a bare minimum 15%. If it's not giving me 15%, it's giving me less than 15%, I don't touch it. This is why it makes perfect sense for me to invest in low-income properties. Low-income properties because they need my 15% return on investment benchmark. You see, now you are making a decision that speaks to your investment objectives and your investment criteria. That is why it is important to know how to calculate your return on investment, because you can measure whether it meets what you're looking for or it doesn't. If it doesn't, then it's a no-go area for you. That was just a simple example of how to calculate your return on investment, and we were looking at a property investment. Let's look at another scenario. Let's say you have the same amount of money, which is 75,000, and you are contemplating between this one that we've just looked at and another investment opportunity that is out there. Let's assume that you have looked at a unit trust, let's say a money market fund, and you want to put your money in there. Let's work out the numbers. First, you need to know the earnings. What percentage of interest is your money market fund offering? Normally, when you go into the websites of your unit trust providers, they will disclose, they'll show you the quarterly returns. There's a very important document that is called a fund fact sheet, which will show you how the fund has been performing over time. As I was working out this, I've looked at this particular website and they do have their rates in there. Let's assume that you are going with this particular unit service provider and they're offering 8.57% on their money market fund. Remember, the 8.5% is an annual rate of return. Remember, there's a rate of return, there's a return on investment, right? These are two things. So they're offering 8.57, and also do remember that, as you can see, as I've displayed there, there's effective rate, there's a nominal rate. I've done a video already explaining the difference between effective rate and nominal rate. But if I may recap, nominal rate is just a simple rate. It doesn't take compounding into effect. But when you look at effective rate, this is the truest interest that you are going to receive. It takes into account compounding, and it also looks at how often the returns are going to be paid. So if the returns are paid on a regular basis, on a monthly basis, on a quarterly basis, or on a biannual basis, this rate is always going to be higher than the nominal rate. We are going with the effective rate of 8.57. Somebody could be asking, is this rate of return similar or equal to my return on investment? The answer is simply no. They are not the same. Why do we say no? Because your rate of return has not accounted for cost of keeping your investment running. Let's work out this scenario. You are putting in 75,000 into the money market fund, which is giving you a rate of return of 8.57%. However, the cost associated with keeping this money market fund is 1% annual fee. 1% annual fee is charged on the investments that you're on, the capital that you're going to put in. So in our scenario here, the 1% is going to be charged on a total of 75,000. However, it is not only 1%. This 1% is exclusive of VAT, of VAT. Therefore, after charging the 1%, we also need to account for VAT. So if we account for VAT, the cost of investing in this money market fund is going to be 855 pula annually. 855 pula annually. But what is our rate of return? What is our earnings on this money market fund? Our earnings, we are going to say the 75,000 multiplied by a rate of return of 8.57%. Our net earnings are 5,572 pula 50. Therefore, what is our return on investment? Our return on investment is going to be the 5,572 pula 50 divided by the 75,000 that we put into the fund. We are going to get a rate of return of 7.43%. Now you see, this is why we said the rate of return and the return on investment are not the same. Because somebody was going to assume that because my rate of return is 8.57%, therefore my return on investment is 8.57%, which is not true because the rate of return did not account for the cost of keeping or investing in that money market fund. This is simply how you can calculate your return on investment. Remember, as an investor, you need to know these words for you to speak the investment language. And you are not going to know these words until you sit down, you start practicing, you start doing your own calculations. Every investment decision that you are going to make, it is going to be backed by numbers, and return on investment is a key metric that you have to keep in mind all the times. I hope you find this insightful. This is all that I wanted to share with you today. Please don't forget to leave a like and a comment for me. Thank you very much for your time. I will see you in another video.